Hey there, Money Mind Motion family. Welcome back to the spot where we keep it real about building wealth that lasts, not the flashy stuff that fades. I'm your host, and on this crisp November 18th, 2025, we're unpacking a timeless truth with a money twist. Slow and steady wins the race, Wealth Edition. You know the fable, the tortoise shells the hare every time. Well, in our world of crypto crashes and meme stock manias, it's more relevant than ever. With the S&P 500 up a solid 14.5% year-to-date through mid-November per Slick Charts data, driven by steady tech resilience and consumer grit, it's proof that patient plays pay off. But here's the rub. While headlines scream overnight riches, the real winners, the 23.8 million U.S. millionaires as of the UBS Global Wealth Report's June 2025 update, up nearly 400,000 from last year, are the ones who plod along, compounding quietly. As we eye 2026 with economists like Deloitte forecasting U.S. GDP growth around 1.4% amid softer landings, and Vanguard pegging it closer to 1.7%, the slow and steady mindset isn't just cute. It's your edge in a market that's averaged 10% annual returns historically, turning modest savers into moguls over decades. Today, we'll break down the compounding magic, why get-rich-quick traps backfire, habits of self-made tortoises, and a 2026 roadmap to steady wins, backed by fresh studies like Ramsey Solutions' National Study of Millionaires showing 79% built wealth without inheritance. This is your blueprint for racing smart. Grab a coffee, settle in, let's tortoise our way to the finish line. Section 1. The Magic of Compounding. First up, the tortoise's secret weapon. Compounding. That eighth wonder of the world where your money makes money on money, slow but unstoppable. Einstein wasn't kidding. It's the force turning $10,000 invested in the S&P 500 at age 25 into over $174,000 by 65 at a conservative 7% average annual return per Investopedia's Evergreen Math updated for 2025 realities. That's not hype. Raymond James data shows the S&P's compounded 14.9% over the last decade through 2024, and with 2025's 14.5% YTD pace, steady index fund holders are laughing all the way to retirement. Rich folks get this. Warren Buffett, the ultimate tortoise at 95 with $140 billion, credits 99% of his wealth to compounding after 50, decades of letting winners run without chasing hares. In 2025, BlackRock's investing outlook hammers it home. Consistent contributions to low-fee ETFs like VOO yield, pretty good returns you can stick with, outpacing 80% of pros over time. Picture this. Sock away $200 monthly from your first job. By 2026, with markets humming at 10% averages, you're on track for $1 million by 60, per Stock Analysis's 2025 Compound Guide. But the hare. Day trading apps lure with 100% promises, yet FINRA stats show 70% lose money quarterly. Slow wins because time multiplies. A $5,000 lump sum today at 7% hits $38,000 in 30 years. Magic no sprint can touch. Start in Roth IRA tomorrow. Let Uncle Sam match your steady stride. Section 2. Why get rich? Quick traps backfire. Now, let's call out the hares, the get-rich-quick traps that promise speed but deliver wipeouts. In 2025's hype cycle, crypto's down 20% from peaks, while meme stocks like GameStop swing 50% weekly, per Yahoo Finance trackers. snaring 60% of retail traders in losses according to a fresh SEC investor alert. Why? Hares ignore risk. One bad bet erases years of plotting. Morgan Housel's The Psychology of Money, still a 2025 bestseller, nails it. Survivorship bias spotlights winners, hiding the 90% who flame out, take lotteries. Americans drop $100 billion yearly, with odds worse than 1 in 300 million. Yet UBS reports only 1% of new millionaires come from windfalls. The rest grind steady or day trading. Robinhood's 2025 user data shows active traders underperform buy and hold by 5 to 7% annually per Vanguard studies. Time in the market beats timing it. Heading to 2026, with Fed rates easing to 3.5 to 4%, hares might chase yield chases, but Deloitte warns volatility spikes could trim 2% off impulsive portfolios. Tortoises? They diversify. 60-40 stock-bond mixes returned 8% annualized last decade, buffering bumps. Lesson: speed seduces, but steady shields. Skip the FOMO. Embrace the plod. Section 3. Habits of self-made tortoises. What fuels these tortoises? Habits baked in daily per 2025 studies on self-made millionaires. Ramsey Solutions national study, surveying 10,000 plus in late 2024, fresh for 2025, reveals 79% inherited zilch, wealth from consistent saving, 15% plus of income, and investing, not lotteries. CNBC's May 2025 dive adds, 93% weigh opportunity cost, asking, is this splurge worth the future growth? Before buys, turning coffee runs into compound fuel. Tom Corley's Rich Habits research, updated July 2025, spotlights 96% maintaining optimistic mindsets, resilient against dips, reading 30 minutes daily on finance, empowers July stats. Self-made folks hit $5.3 million net worth goals by automating 20% savings per Fidelity Echoes. 80% save that chunk annually. Real Tortoise, a Midwest teacher socking $300 per month into index funds since 1995, now millionaire at 55, per similar Ramsey profiles. Habit stack, track net worth quarterly, live below means 97% do, avoid debt traps. In 2025's gig boom, side hustles add 10 to 15% income, but tortoises invest it, not spend. Fidelity. Consistent automators build 3 times faster wealth. Adopt one today. Your shell's tougher than you think. Section 4. 2026 Roadmap to Steady Wins. Peering ahead. 2026 is your year to tortoise harder, with a roadmap for steady strides. Vanguard's latest outlook projects 1.7% GDP growth, tempered but resilient, perfect for compounding without chaos. UMIC's November forecast ups it to 2.2%, with unemployment at 4.3%, jobs stable, wages up 3%. Start, max your 401k match, free money averaging 4 to 6% instant return. Then, Roth conversions amid lower brackets. IRS 2026 limits hit $7,000 for IRAs invest steady. Dollar cost average $100 per week into VTI. Money with Katie's 2025 guide shows 7% safe averages via S&P trackers. Sidestep hares, skip NFTs, down 80% from 2021, favor REITs yielding 4% amid housing crunches, UBS eyes, 24 million millionaires by year-end, 40% global share, joined by saving 20% per Empower. Track via apps like Mint, review quarterly Deloitte, balanced portfolios gain 12% in steady years. Your 2026 mantra: plod, compound, repeat. Millionaire status awaits the patient. Section 5. Real stories of slow victories. To drive it home, real tortoise tales from 2025. Meet Sarah from Ohio, started $50 per month in a Vanguard fund post-college. By November 2025, $250,000 at 42% per similar Ramsey case studies. Or Mike in Florida. No inheritance, just 15% saving since the 90s. Now, $2 million retired early, echoing Corley's 96% optimists who persist through 0, 8, and 22 dips. These aren't unicorns. UBS data shows everyday millionaires, 1 to 5 million assets, quadrupled since 2010. Grinding steady, your story starts now. Slow shells the sprint. Conclusion. There it is. Money Mind Motion Crew, slow and steady wins the wealth race through compounding, smart habits, and patience in 2025's 14.5% market glow, eyeing 2026's 2% growth stride. Ditch the hares. Be the tortoise. Save 20%, invest consistently, think long. Like if this resonates, subscribe for more steady wins, comment your first plod, keep motion tortoise style, your empire's building.